Today, dear investors, dear partners, dear listeners, today we have gathered for a meeting for Baltic Horion annual general meeting on this lovely first day of summer. We have several investors in attendance, as well as Baltic Horion team in attendance. We have the chairman of the supervisory board, Antanas Inskaitis, me, the fund manager, Edvinas Karbauskas, then the management board member, Gerda Bliviene, and our team, Yana Karimova and Indrek Vilms. Let's begin the annual general meeting, and we will have 5 items on our agenda today. Firstly, we will cover the audited annual report of Baltic Horion for the financial year 2025. Then we will also overview the plans and the strategy for the remaining part of the year. And we will have 3 voting items today. One is the election of the potential new supervisory board member, Brit Parents, remuneration of the newly elected board member, and then an extension of the mandates of all current supervisory board members. For this meeting, I will be the chairman of the meeting, while Yana Karimova will be the secretary of the meeting. And I'm glad to announce that today we've reached a quorum. Over 50% of the investors of the fund is either attending live or has appointed a representative through power of attorney. So we will have the voting power to reach decisions today. Let's start with 2025, and I give the word to Antanas Inskaitis, the chairman of the supervisory board.
Thank you very much, and good afternoon, everyone. To put 2025 into context, the figures have been published on the website. You have all had a possibility to study the report. 2025 was also a very eventful year for us. We joined the turnaround of Baltic Horion Fund in full. We is a private investment company under a name Greenvest, which has invested into the fund in first time in 2024, at the time when the fund was raising through private placement funds to support its liquidity needs. We invested then, and pretty soon we realized it's a much more complicated, much more demanding undertaking than just being a passive investor after that step. So I would like to share here with you, fellow unit holders, and also from now my chair as the supervisory board chairman of the management company, where did we find the fund at the beginning of 2025? And how did we proceed with the assessment of the situation and the steps we have taken, in particular during the first quarter of this year, in further strengthening of the capital of the fund? So we invested in the autumn of 2024 at the invitation of the management team back then, under the assumption that the fund needs certain amount of capital to successfully bridge its interim need for cash and turn its fortunes around, meaning that the properties will acquire more tenants and the money will be used to accommodate these incoming tenants with fitting out the premises, etc. However, we realized that the money which was raised in the autumn of 2024 was absolutely insufficient for the fund to continue running solvently. And it was mainly because the fund was over-indebted, had too much debt from basically from before the COVID. And that problem has dragged on the fund for the last 5 years. The volume of debt was impossible to service just to pay interest and repayment of the loan amortizations. And another problem has been that once you have loans which you cannot service, or those loans are in breach of financing covenants, those loans could be called by the creditors. And once one of such loans is called, the other ones obtain the same right, also known as cross-default clause across different loan instruments, including the bonds which are held by the fund itself. And that in combination with continuously negative cash flow, so fund was always spending more money or collecting less money than it had to pay to service debt and service properties. We realized that this fund is running out of money. If nothing is done in a year or so, the fund is running out of money, literally, and the creditors will obviously take their own rights according to their loan agreements. That was a scary reckoning, and two figures which are shown here in the black, the consolidated debt service coverage ratio for the entire fund for 2024 was 0.78, which means that the fund was only collecting 78% of cash flow needed to service its debt. So it was burning money at a very great velocity. And another figure, 62% of loan to value, meaning the value of all loans compared to the valuation of the investment properties held by the fund, was also at a very steep level, in combination with the property values, which were very difficult to achieve in any disposal attempts which were undertaken by the previous management. So this was an obvious over-leveraged situation. Furthermore, the portfolio of properties this fund owns, they have been beaten by different factors over the last 5 years. So the performance has been deteriorating, and reletting has been taking place at lower rents than the expiring lease contracts, required fit-out contributions, and were in many instances very lengthy undertakings to fill the vacancies. And given that situation, management was trying to sell whatever is sellable, and those were difficult projects. Some of them materialized, but they were becoming more and more desperate as it was becoming obvious the fund would run out of money. So before we entered into more close cooperation with the management, we first started looking around. Now that we have invested quite a significant amount of money, who are the other big investors who have been invested for a long period of time, and what do they think about this fund? What can we agree to do together as the capital providers for the fund in order to turn our fortunes around? We started approaching these different investors, and we pretty much, over the first calls, realized there has not been a single leading investor who would have been a supporting investor, motivated and invested here consciously. So that was a big reckoning where we found out basically we are alone. Not to say that all of you who have invested into the fund are not there, but there has not been any other large investor who would have said, yes, we want to join the governing structure of the fund, the supervisory board, and we have an idea of how this should be handled so that the fortunes are turned around. that's when we realized that we have to get involved in much closer supervision of the management. And we appointed in 2025, we appointed a new composition of a supervisory board of the fund, which is a different body from the supervisory board of the management company, of which I'm a chairman now. And I'll say a few words about what was the role of this step on the next slide. But basically, that was the year of reckoning when we, as Grinvest, as the investor who started in 2024, we realized we have to take an active role because there is no other investor. And this management, without the support, any management without the support of investors cannot turn this fund around. It will be a very dire situation for everyone involved. So the first step we've taken, we've appointed the supervisory board members of in the fund. I was one of them. There were two other members, independent in a sense, not owning any units, professional chairman appointed by us. And it has been a very intensive period. Tarmo, as former manager, may witness that. We worked throughout the summer of 25. All in all, since May to October, beginning of November, when we, Grinvest, acquired the management company, there were at least 7 formal supervisory board meetings taking place, and basically focusing on the true crisis management. So going through the budgets together, cutting all non-essential costs, reviewing most complicated, most urgent, burning property matters, reviewing capex. And then we, with the recognition that without new capital, this fund cannot continue, we also declared to the former owners of the management company that for us to lead a new recapitalization of this fund, we have to have control of the management in a sense that we would also own the management company. It has taken a few months to come to an agreement on the terms of this further commitment of ours, and by November last year, we acquired the management company and immediately proceeded with the steps of raising new capital, which was implemented in the first quarter of 2026. Coming up with the idea of how this new capital should be raised was not easy because we had to provide fair treatment to all existing unit holders without allowing external new capital to squeeze everybody out or those who are not participating out. At the same time, it was obvious that if we are not investing into this new recapitalization, it will be very difficult for us to acquire trust of anybody else. So we had to take part ourselves as the largest unit holder and now as the owners of the management company. And therefore, we, after many consultations with different advisors, lawyers, some of the other bigger unit holders, we offered something which is very similar to an instrument called rights offering. So all those who were the unit holders at the time of the raising were offered a proportional share in the new capital if they wanted to. And we have undertaken to take our part in it, which we did. We are glad to see that quite many other unit holders have taken part, including some of the bigger ones. And that recapitalization, a necessary step for the company to complete its 2025, with auditors allowing this to be called a going concern, a company which is solvent and has a proven business plan to continue going forward. So I wanted to give this overview before looking into figures, because this year, 2025, was a year of many turnaround steps in hopefully stabilizing the capital structure of the fund. Gerda, if you could please take over and walk us through the figures.
Good afternoon. I would like to present the audited financial statements of 2025. Those were audited by our long-term partner, KPMG Estonia. So I will start with the income statement. As you can see, total revenues for the 2025 was around 20 million euros. It was at a similar level as it was last year. But it should be noted that in 2025, there was also Meraki, one of our assets, which was sold in the mid of March. So it also includes 2 months of Meraki performance. Our property costs slightly increased to 8.4 million euros, and it also includes allowances for bad debts. As you can notice, the amount is significantly higher compared to the last year. It was like 540,000 euros, and it reflects, I would say, our stricter financial policy when we came to this management, in relation to the change of the management board. This is one of our clearest priorities, I would say, to have more strict view on all of the items. Accordingly, our NOI was almost at the same level in 11,700,000 euros. Getting to overheads, those were slightly decreased due to 2 main reasons. One of them was lower management fee in relation to lower net asset value of the fund. But also you can notice that our administrative expenses were reduced. We're still doing that aggressively, I would say. We're reviewing all the costs we have in the fund and SPV level just to reduce anything what is really not necessary. So EBITDA was 9.7 million euros, slightly better result than it was last year. Back in November 2025, we have our independent property valuation performed by NewSec. The loss was a significant one. It was almost 21 million euros. But I can admit that it is still challenging still to receive the prices which were quoted in our property valuations on the assets which we have for sale. Because team is really working on that, but maybe Edvinas will comment more about that. Talking about financial side, our interest expenses makes a real pressure also on income statement and then cash flows, as we have that bond we all knew about it, and it carries a really high margin, 8% plus Euribor. So this more than 10% of interest expenses at all. So this is one of our clearest also priority to get rid of that as soon as we can. Talking about some metrics, it is really glad that now we reached, at the end of the year, we reached this year, which is above 1, what means that the fund is starting to cover its debt obligations. But, we are committed to strengthen it further. And as well, we can see that our debt to EBITDA ratio is still really high. It is 14 when I would say market practice, it should not be more than 8-9, but we are still getting there. And average cost of debt was slightly due to changes in Euribor and as well as the prepayment of Meraki, of the bond when we sold the Meraki. Getting to the financial standing balance sheet, our investment properties was 209 million euros. So it is a huge reduction due to 2 main reasons. It was the same valuation as well as the sale of Meraki. As you can see on current asset sides, we have cash on account split into 2 categories because we see that this kind of split approach is a better way for investor to see the liquidity of the fund. Restricted cash means the cash which is on an SPV level in each of the company, but only that company can use this money for this operating expenses, capex or debt services. And only 1.4 million euros at year end was the money the fund can use freely to pay bond interest, to pay its expenses. Trade and other receivables was also significantly reduced due to the same two reasons. It was due to bad debt provisions, but also as well as we started to aggressively approach our tenants who does not paying. We started to monitor a lot our all of the debts. Talking about the equity side, paid in capital remained the same during the year, as there was no capital strengthening, but it was a huge loss during the year, mostly due to the valuation. So we ended up with 78 million euros on the equity side. Bank loans on the long-term side, you can see 77 million euros. Although we have more, there was additional 20 millions which are on the short-term side because some loans breach the covenants. We already covered during Q1 and we solved those issues. So it is already long-term loans. So it is above 20 million euros. And at the year end, there was only two loans which were expiring. It was Vienodas and LNK, but it was conditional loan prolongation because the creditor SCB asked for at least 7.5 million of capital strengthening. So when the capital was raised, we managed to prolong it in Q1. Our bonds as well was like short-term liability because, as you know, our equity ratio due to property valuation loss was 36.1. It was a really huge breach. And due to the active management work, it was capital was raised, managed also to fix this covenant breach. So our total liabilities this year decreased mostly due to reasons that Meraki was sold. I'm aiming to total liability side, that Meraki was sold and all the sales proceeds was to use for our liabilities, to cover our liabilities. So we ended 2025 in the start of transition, and we entered 2026 with new priorities like reduce interest expenses, reduce administrative costs, and improve our performance of our assets. Some of the progress can already be seen in Q1 results, and then Vilnius will maybe explain more.
Thank you, Gerda. Thank you, Antanas. Indeed, 2025 was the legacy year where we still had the major burden of the bond, but hopefully 2026 can become the year of turning point, and we already see some transformative actions and results. So, firstly, at the beginning of the 2026 in Q1, we made a lot of adjustments to our property management teams, which actually helped us to improve the recoverability of costs from our tenants. So without major increases in the occupancy compared to the same period last year, we managed to achieve 4% higher service charge collection rate, which is already showing some operational efficiency, as well as reduce our cost basis for the assets. I'll talk about that a bit further, but basically we managed to reduce the costs by a significant amount, and I think we will see the full magnitude of the changes throughout the entire year of 2026. So still, NOI remained roughly the same, but compared to the previous year. But in the last year, we still had Meraki asset, so this is we're at a bit higher level even without one asset, as well as this is finally the first time in many quarters where the fund has reached profitability. And compared to, for example, previous years, first quarter where we had a loss, we've managed to turn the time around and have a completely different outlook on the results. And if we also consider the one-off costs which we had related to the capital raising, to the bond repayments, the fund would then be at around 500,000 euros of profit for Q1. So we're definitely seeing a bit of positive trajectory, but still it's just the first steps. And as mentioned by Gerda, we are closely monitoring all bond and financial metrics. So as you can see, the SCR is slowly turning to 1.1, and we have the goal by the end of the year to reach 1.2, which is also mentioned in our bond rules. So we are moving closer to that figure and having at least a bit of headroom to cover the debt. In terms of our financial standing, as you all know, we've raised around 12 million during the last capital raising, almost 50% of all pro rata units that could have been raised. So we do consider this a good result, and it gives us the capital to work with the assets, as well as part of the capital immediately went to repayment of the bonds, to again deleverage the fund. So this was the key balance sheet change during the first quarter. In terms of investments, we made some small investments into the properties to enhance the properties and achieve leasing results. And generally, the NAV at the end of Q1 already reflects the full impact of the capital raising. As well as, I think it's important to note that we've made material steps towards kind of reducing the stress on the bank loans. As Gerda mentioned, many loans are now out of the breach, and all of them are not in any covenant breaches. But so we managed to prolong them, and now we only have Pirita as the only asset who has a loan expiring in the next 12 months. And on the prospects of Pirita, I'll comment a bit later. So mostly, at least for now, the immediate crisis is managed, and we can work towards our turnaround objectives. And as the management of the fund, as well as with the support from the supervisory board, we managed to conclude that there are 3 turnaround objectives which we must achieve prior to anything. First is we must ensure that the fund becomes profitable and cash flow positive again. Even though we see that there is a net profitability for the first quarter, there is still capex works and that we need to deploy. So we are still working heavily to have the actual cash flow being positive. And to improve the results, we've deployed fully new property management teams, which is now fully insourced. In the past, we used external partners to handle the property management services and as well as the leasing side. But now the entire team is hired into the fund and providing services just specifically to the fund exclusively. So the motivational side is one directional towards the same common goal, which is one of the key attributes for us in the turnaround objectives. And of course, as mentioned by Gerda and Antanas, we've have very stringent control on the overheads and any property expenses, which is not kind of essential for the services, and even the essential services are being tendered quite actively. So on the property side, we tendered majority of the services towards cheaper contracts. As I mentioned, the result will be seen later this year, as well as we've reduced the majority of overheads to have just the bare minimum of the cost that we need to run this fund. And hopefully in the future, we can also find additional ways to remove it and reduce it. And as a result of this, we are hoping that all of these actions can also kind of allow us to work with the banks, show a bit of more positive results, and then hopefully remove and reduce the cost of borrowing as well. And the second point on the turnaround is our properties have to become competitive again. There have been times in the past where we had prolonged vacancies. So this is now fully being addressed by the deployed teams. And our general target, of course, is to have the net positive leasing. At the moment, we have around 85% occupancy. So definitely our aim through this year is to increase it, which then helps the cash flow. And we are hoping that some of the rental conditions in the current contracts can be improved upon the prolongations of the lease agreements, which is another side that we are working closely. So generally, we together, the management board and together with the property teams, we underwent through full review of our all leasing contracts, all costs, and have done a concrete action plan how we are going to decrease the costs and increase the leasing and rental agreements. And hopefully we can also achieve a bit of efficiency through CapEx. For us, as also Antanas mentioned, the fund needed quite significant amount for CapEx works. But we're trying to really focus on what's crucial at the moment and only deploy such CapEx works. And then once we see that there is actual positive movement in the results, then we can consider non-essential items as well. So these first 2 points is mostly about engaging our teams and working a lot with the assets. And then we have the third objective, which is the sustainable capital structure. And this fund had the sustainable capital structure for quite many years now, probably since COVID-19, and we're hoping to turn the tide. So we reiterate and clearly state that our goal is to achieve below 50% of LTV and cover the debt, especially the bond, as soon as possible. And hopefully in result, working more with the banks and achieving sustainable cost of debt, which at the moment, at least in my opinion, it's not sustainable and we must reduce it further. So, so hopefully we can achieve that. And as our top priority, we declared many times, but I'll reiterate that we have the goal of repaying back the entire bond as soon as possible. And we can do it realistically through disposals or further capital injections. But with the remaining part, I think there are concrete steps that we can take to reduce it as soon as possible. And of course, once we've done all the work with the bond, improved the assets, we can then hopefully restore the top tier lenders' willingness to finance the long-term debt and reduce further our cost of debt. And our plans for 2026 generally reflects the key goals. But there is very concrete decision that we have made inside the management company that unfortunately we cannot continue or restart the distributions to investors until we reach the turnaround objectives, as well as we will not be taking any decisions on further capital injections until we have solved the turnaround objectives. And I think at the moment we are going through this transition phase, looking at the realistic situation of the fund, where we can get it within the next 12 months. And then once we've dealt with the fundamental immediate objectives of leasing the properties and working with the assets, then we can look at the strategic options of the fund, what can be done with the assets, and what we can achieve. What's the best outcome to return the funds to the investors, whether it's to after stabilizing the portfolio, return to distributions, or are there any further sales that we should do and kind of return the funds to the investors through the disposals of the assets. So in terms of the plans, we generally working tremendously on the leasing side. So leasing is the current phrase we have in the fund. And throughout the past quarter and the beginning of this quarter, we've worked a lot on our Latvian assets, where we signed a new anchor lease with Abrams Cash and Carry. We needed this new tenant because our previous tenant, Sky Baltic, in the Hippokrate asset, which was previously Sky asset, went bankrupt. They declared bankruptcy in March, and we immediately found a new anchor tenant who can kind of occupy the building and still provide the positive cash flow for it, as well as we've been in the past several months working closely with ELVM, one of our largest tenants and the one who fully occupies this building, to find a long-term solution. I think we found one. We signed an agreement with them, and they will hopefully be staying in the building until 2034. So we're still working out the structure and how to best support them as a tenant, but we've managed to reach an agreement on the formal side of things, and hopefully we have them for a long term. As well as we've been working on many different partnerships, and one example I want to point out is Divinity, where we signed a lease agreement with them as well as a partnership agreement, which both helped us to lease the properties as well as achieve good partnership results through our property management side and kind of the cost side on the assets. So we are aiming to do more of these partnerships in the future, hopefully resulting in further leasing activities. And the last item from the leasing side is we managed to sign the prolongation with MyFitness and an expansion. They will be expanding in Postuma in 2027. So it's another way to secure tenants for the foreseeable future. And these activities truly, in a sense, help us to stabilize the fund, as they are prolonging the weighted average lease term of the fund, which now has gone from 3 years, roughly at the start of 2025, to 4 years at the beginning of 2026, and now hopefully even to a higher number of having a stable cash flow and less risk of these kind of tenant changes and them moving away from the assets, which was the case throughout the past 5 years. I think there have been many cases in Lincona or in Upmalas where a large tenant left the building, creating immediate pressure for the assets. Now we're kind of getting a lot of new leases, which is in a modern sense and size at 500 to 1,000 square meters. So we have more diversification, hopefully higher vault. And as the other objective, we had the costs. So our goal for this year is to have the the run rate of overheads at around 100,000 euros per quarter, which is without the management fee. And this is a significant reduction from the previous overheads which we had in the past. Again, reducing the stress on the fund and on the profitability. We are finishing with the onboarding of the property operators, and this task is now mostly finished. But as I mentioned, we will still be undergoing some partner changes in the assets. So hopefully during this year we can have the full base where we have the full property management competence in house, and then the partners that fit us right and can help us achieve the goals which we outlined. And of course, it's not 2026 if we're not using AI. So we're deploying a lot of AI in our daily work. So we are looking to how to enhance our property performance by also deploying some AI tools, and especially in sales, we use a lot of them. So hopefully this can result in a improvement on the sales side as well. And the last one on the item list, we have the disposal targets. We've been vocal about the need to dispose at least 1 or 2 additional assets. So we are going through with the plan. And at the moment, the 3 key assets that we are considering for sale is Pirita, Hippokrate Center, which is ex-Sky, and Northstar. In all 3 cases, we have suitable buyers at the moment and already engaged discussions. So probably throughout the next couple of quarters, we will see if the negotiation materializes. As well, as you may know, we have declared in the past that we're not selling the assets below the book value. So all 3 suitors for all 3 of these assets are in the range of current book values. But as discussed and said by Gerda, there's definitely a bit of pressure and difficulties to actually achieve the sales at the current book values. But I think through kind of constructive talks and creative solutions with the potential partners, we can achieve the book price for these particular assets. And of course, the main objective of selling these assets is to repay back the bond. So whatever free cash we will have from the disposals, we will use to further decrease the bond. And I think this is a more appropriate way to reduce the bond rather than kind of trying to get additional capital from the investors and doing dilutions. This is mostly our goals for 2026, and we will definitely be communicating more about them in the future as we see the actual results of our actions. But now I want to focus more on the voting items of this general meeting, and the first one being the proposal of the new supervisory board member, Brit Berends, who has an extensive experience in the banking industry. He was the CEO of Swedbank Estonia and worked in the group executive management team. So we are proposing Brit as a new supervisory board member from June 1st. With this, we're trying to strengthen the Estonian presence inside the fund, and having an experienced professional as Mr. Brit can deliver additional value to the shareholders and to the entire management team through his support and his consultations on the management and best practices for the governance of the fund. As well as I want to announce that as of today, Ms. Milda Dargužaitė, who was the previous supervisory board member has resigned from her position. So with Brit, we would again have 3 supervisory board members of the fund. At the moment, we have the chairman, Andrius Maliukas, and then Professor Per Jenster. So today we are hoping to achieve 3 resolutions in line with the mentioned information. First is to elect Mr. Brit Berens to the supervisory board for 2 years from today, 1st of June 2026. Approve remuneration of 11,000 per year for the new supervisory board member, Mr. Brit, which is in line with the current remuneration of the current supervisory board members. And then the third item is to extend the mandates of all current supervisory board members until 1st of June 2028. So, and aligning all of the mandates to the same term and having now clear supervisory board in place. We are now beginning the voting. We have received some power of attorneys prior to the meeting. As I mentioned, we have the quorum today, so we can pass decisions. And in the meantime, while we're voting, we can proceed with the Q&A section. We have not received any questions to this annual general meeting beforehand. Let's look if we have received any questions during the webinar. It seems not. So if anyone has any questions, I encourage to raise them. And hopefully we can answer them.
Yeah, I have a question. So about those bonds outstanding, do the terms include any like limitations to pay them back prematurely, or are you flexible? Anytime you have liquidity, you can do that.
Yes, I don't know if the webinar attendees can hear the sound because we're in a quite sizable room. So I'll repeat the question. Basically, the question is about the bond limitations. Are there any limitations that would prevent us from repaying the bonds? So maybe Gerda, you can answer.
The only one limitation is that the minimum amount we can repay is starting from 3 million euros. This is the minimum one.
And if I may add, another small limitation is that every repayment costs repayment fees. So there is a little penalty which the bondholders will charge, and that penalty is diminishing as the time goes. So the later the repayment takes place, the smaller that the repayment early repayment fee.
And as mentioned, if we have free cash, then definitely it will be used. If we reach this 3 million threshold of free cash, which we have, then we will immediately repay the bonds.
Please ask further questions. You've been very cheerful before the meeting.
Yes, sure. Maybe we can do like a kind of official meeting and then we can have some discussion. But yeah, what was my interest? Yes, there was like 3 properties on sale, so you have that open discussion. But what do you believe? Can the deal see already Q2 or more probability Q3 this year?
Forward.
Or 4? I mean, the Pirita and the ex-Sky Center, etc. Also, this is the biggest challenge is that your expectation on the pricing, and definitely they would like to get a very good pricing, but it's like a very big difference. What is your expectations and what are the buyers expecting?
Let me help here answering this question, because it's part of the information which maybe is confidential and should not be communicated to the market before it's firm binding. This fund, like any seller in a situation like this, is on a very delicate negotiation power or lack of it. It's obvious that everybody would like to come and buy a good asset for a very distressed price. And the duty of this management towards all of the unit holders is not to allow such distressed sales to take place for as long as better options are available. And therefore, the communication this management were giving to the market, to any potential buyers, is first of all that there are 3 properties identified for sale for different reasons why these 3 are selected, mostly because this management, and we believe that they are liquid, they are smaller in size, they should attract certain smaller type of investors who are still out there on the market. A, B, they are in a decent commercial shape, so they should be okay to finance with bank loans, and therefore make some sort of buyer interested. I think we can answer today in terms of future guidance that it's not likely that any of those disposals would close in Q2, because Q2 is essentially this month.
Yeah.
And we have also communicated on this meeting that we give it Q3 to see how much of disposals can take place. And if that is sufficient for the management to believe that we are on the right track to repay the bonds or not to face the bond breaches before the year end of 26, then we are not bringing up for the consideration of the management and supervisory board and ultimately the unit holders a question of new equity raising, new capital raising, because that would be an obvious way to solve this over-indebtedness problem. So Q3 will be very important in terms of how the disposals of these 3 or few of those 3 properties are progressing. And that's the calendar which is in every one of these conversations which the management is having with prospective buyers. But we cannot, once there are binding agreements, those would be communicated to the market, to the stock exchange. Until then, you can say today there are no commitments regarding any of the 3 sales. So.
We're recording now.
We're still recording, yes. There are online question about is the share of units published somewhere to the majority, like the majority of unit holders, are they reported somewhere? So we have the report on the unit holders in our quarterly and annual report. There is a section at the back of the financial report where one can see the investors. Unfortunately, in the current setup, Nasdaq does not allow us to see the full unit holders, as some of the unit holders use nominees like banks to hold their accounts, and then we can only see the banks. So we are disclosing as much information as we can. Any other questions? While we're waiting for the voting results. Yes.
This is interesting. You're mentioning here property management as an in-house role. How is it managed today? If it's your objective to become managing in-house your property, I was assuming this is part of the operating procedure.
So it's done already.
It is done. Already.
Yes. Just we initially we deployed and hired the full property management teams in house. But as you may know, like for the fund of such size, there are definitely some transition period which is needed, hiring the right personnel and deploying them. So we now in Q2 are mostly done. There's one or two positions that still are up for debate, but basically the entire fund and all assets are now managed by internal.
Does it mean staff recruitment or still outsourcing?
Could you clarify the question?
You said hiring. Hiring means you are going to recruit people versus outsourcing.
Yes. So the people are fully in-house and recruited to work in-house. There are some people that are working within the fund limits and the restrictions that we have under fund rules that are working inside the SPVs and subsidiaries of the fund. There are some other people who are exclusively working with the assets and providing services on a contractor basis. But they are 100% dedicated just to these assets in all 11 assets that we have.
In 3 countries.
Yes. So it's different teams for different assets, not just one. Every single asset has an individual property management team. The bigger assets have typically the team of 4 or 5 people, and the smaller, for example, in case of Hippocrata, there's just one person who is providing the property management and the leasing service. But then we, of course, have outsourced facility management and another.
And it's more cost effective to do such way?
Yes, definitely. I would say that there are first of all we get the full dedication, and then second of all it's cost effective because we can avoid brokerage fees, we can avoid some additional service fees, and you have a full dedicated person where you have typically the salary, but then some, of course, motivational scheme as well.
Do you have also like a long-term strategy available right now, assuming that everything goes very smoothly, very well, and potentially maybe 27, 28? Are you planning to start acquiring some new properties, or what's the long-term goals?
Let me help here with management because let me be very honest here. There are different ways in which this fund could continue living a successful life. But we have to get there to have that platform which will allow for a choice.
Yep.
For now, this fund, we can fantasize about growing certain type of ownership of certain type of assets. If the competence of the team, let's say, is all about, just to give an example, these city center properties like Postimaja and such assets in Riga and Vilnius, or something else. But for now, this is a luxury conversation which we cannot honestly have. There are certain ideas what this fund could be, but first of all, it has to stop burning cash and address the over leverage. And once we are there, then we can have trust together that this works, that this has some sort of future. Because again, quite honestly, if it doesn't, this fund should liquidate in a gradual fashion if the market conditions are such that the assets could be sold at meaningful prices. That's what it should do if it cannot stop burning cash. We came to this recognition. What we cannot afford to do is just to go and sell to the first buyer for whatever they paid today, because it's not the quality of the assets not the quality of the market conditions now we're facing. We would all be left with nothing. It's just to go and do a spring sale, so to say.
Absolutely. I think
They're all left with nothing.
It might. It might. It's all of us around the table with the same care and the same hope that this will work out.
But you come across very inspirational, so.
Inspirational is not enough. Delivering is what we do.
To have positive outlook, not all negative.
yeah, I absolutely agree with Antanas. We have to be brutally honest with each other, with investors, with partners, and then once we underwent the full transition, then we can set a clear strategy for the future. At the moment, I do believe it's too early.
I have a question. How about some CapEx or pick out needs for the next, let's say, 12 months? Any major needs there, or you said you have cut back the non-essential things. How's that going?
Well, most of the capex that we have budgeted at the moment is going towards the improvement of the assets related to tenant activities, so signing of the leases, prolongations of the leases, and majority of the costs is attributed to there. And then once we have done and have kind of stabilized the situation, then we can consider more long-term asset enhancement activities.
It's still 15% of the space in the portfolio which the fund owns today, which has no tenants. And most of that space, to get a tenant in, will require some expenditures on behalf of the landlord, meaning the fund. So negative outflows to get that space filled, they are there. They will be there. But in terms of the budgets which are prepared for the properties and the liquidity which the fund currently has, it seems the fund would pay for such expenditures over the period of next 12 months, to answer your question. So CapEx can be funded. The real challenge is that the cash flow of this operation cannot continue repaying the bonds and other excess debt. So that can be only achieved through property disposals. Having repaid the bank, whatever is left could be used for further down payment of the bonds.
15% vacancy is not critical, but it depends where they come. If you have 5.6% to service the loans,
it's the problem of averages, that one who is dead and one who has a fever on average is 36.6, but the problem of averages is that some properties have too much vacancy to be operationally, especially when you go into shopping centers. A shopping center needs certain minimum level of activity so that it is on the right positive track in terms of customer experience, in terms of cash flow, in terms of further leasing fraction. It's not that dramatic if you have, one unit in an office building vacant. The other office tenants are not so much affected by it. But then, of course, keeping vacancy costs money just to keep the vacancy. Real estate taxes, security, cleaning of the territory. So there is a cost to vacancy.
We have now the results of the voting for the 3 agenda items. So I think we can announce it and then continue the discussion in an informal setting. So As mentioned, we have reached the quorum today, as more than 50% of the whole fund investors and unit holders have registered for this meeting through attendance or power of attorneys. So first agenda item was the election of Mr. Priit Perens as the new member of the supervisory board of the fund. In favor of Mr. Priit has voted 123,882,973 units, which is roughly 99% of the whole attendance of today's meeting. So the decision is passed. Against voted 909 units. So the decision is passed, and Mr. Priit Perens will become supervisory board member of the fund effectively as of today. On the second agenda item, we have the decision to pay remuneration of 11,000 euros for Mr. Priit. Again, the decision is in favor. 123,808,473 units have voted in favor, and then 909 units have voted against, and we had 74,500 units being neutral. So the decision is passed, and Mr. Priit Perens will receive an annual remuneration of 11,000 for his tenure as the supervisory board member. And then the last item is the decision to extend the mandates of all three supervisory board members of the fund until 2028 June. So 123,878,382 units have voted in favor. So the decision is again passed, and 5,500 units were neutral. So all three decisions are passed. The mandates are extended for 2 years. Mr. Priit Perens is elected, and with this, the voting is fully done and legally binding. So for those who are in attendance through webinar and online, I want to thank you. There are no further questions in the webinar. So thank you. It was lovely to have you, and see you next time. Bye.